Good morning and welcome to today's Q&A call. This call is all about you out in the field. So we are talking about what you need. If you have a question or if you have something you want me to show you, work on, drop it in that chat box. Let me know what it is and we can get started with your topic. So again, it is all about you on the call. If you do have something you need to see, drop it in that chat box and we will get started with your topic. So let's get started with Janet. Can we do a down payment assistant with a 3% gift and a 2% 0 second? Absolutely. So we're going to go ahead and start it off. What product do you want to use, Janet? FHA. So we're going to go ahead and put in the basic information that I would normally always put into a presentation. And I'm going to put that this is a purchase. And I'm going to put DPA on this as well. Contact information, your new home. And the goal is purchase a new home. How much do you want me to have them qualify for? So remember, when working in Mortgage Coach, the only thing that you need to make sure that's filled in is those little red indicators. So you can be able to go through, just fill out those red fields and you will be able to have a complete presentation. It's going to be a $400,000 home. Then in the affordability, I'm going to skip it. There's nothing in there required to fill in and we're going to go straight to product one. This is our FHA basic 3%. This one's going to be without DPA. We're going to go on down. I would give it the down payment amount, 3.5%. Interest rate, let's say 4.125. It's a 360 term. And then moving to the next screen. Here's where our closing cost detail is. So there was a question on, can we import fees so they don't have to be manually typed in? Unfortunately, you cannot. You do have to type it in. However, it is really easy. After you built that first one, you can copy that first one and then just make changes for the other ones. So it really doesn't take that much time to build these in. I'm going to drop in my FHA. Of course, I always verify anything I do need to add in here based on my own templates. I would go in and add those in. Once I'm happy, applying that to the loan. So I'm building out a basic FHA, and I forgot to do my upfront MI. So I did go back to add that upfront MI. I'm going to say 15 days, prepaid days interest. My upfront MI, 1.75. Adding that to the loan amount. And then I'm going to put in basic hazard insurance, property tax, and reserve months. So at this point, I build out a basic FHA loan, my 0.85. It is a minimum cutoff of 360 months. So any questions on building that initial first basic template? Okay, looks like we're all good there. So next we're going to go to the add a second product. This is where I'm going to add it with that down payment assistance and that gift. So I'm going to go ahead and put FHA with DPA and gift. I am going to copy it from my original FHA. Now, why am I showing both? Because you never want to show just one product. because you're not being able to have anything in the graphs. So you always want to have multiple products in there when you are showing it. I would go in and make any adjustments here based on that scenario. I'm not going to change anything yet. So everything's going to remain the same. Going to my closing cost is where I'm going to do my work. So in this, I'm going to add, let's do the down payment assistant first. That's going to be added as a fee. We have a fee in Mortgage Coach called down payment assistance. So I'm going to go down, find my down payment assistance. Clicking on there, I'm going to add that 2% down payment assistance. And I like placing it as broker paid. It is a third party paid fee, so I'm going to place it as that broker paid fee. Now, and I have not looked if we have a gift fee. If we don't, we have a grant. There's no gift fee. So we're going to add a custom fee. Or you can use that down payment assistant fee on both of them. Now, if you add a custom fee, you do have to remember some facts because this is money being subtracted from the cash that they need to close. So I'm going to call this gift funds. And the percentage, make sure you're choosing it's on the loan amount or the property value, whichever one it is, in this case, loan amount. And then I'm going to click on this default prepaid. This means this is handled before it goes into escrow on the closing. So this is something that they're going to do beforehand. Reason why we're going to check this is also, we're going to take any of this logic out of that short-term savings block. So that graph with the short-term savings, we don't want it to reflect in there. So I'm going to go ahead and click on OK. Now it's made, the only difference I have to do in here is when I go down to my gift funds, I would use a negative 3% to the borrower. So that is how I would show that gift fund. Other thing that I would need in here, of course, would be the processing fee. I would add in my down payment assistant processing fee, typing that P to get to where I need to be, and scrolling down to processing, and I'm going to say it's a 1% processing fee. Again, you will see it is an APR fee, whether it is the down payment assistant processing fee or your own processing fee, that is always an APR fee. And then I'm going to apply it to the loan. Any questions on that, Janet, or anyone else? Looks like we're all good there. You'll see because I did copy from that original. So gift is on the sales price. So that's what I did place it on. I did place it on, actually, I'm going to go into the custom fee just to show you, on the loan amount, which is typically the sales price. Actually, yeah. So it would be the property value. So make sure you're choosing the property value if that's what your gift is based on. Any other questions on that? Let's go ahead and finish this off just so we can see what it looks like. Everything did pull over because I did use that template. We sure can. I'm getting a lot of template questions, so we're going to go in that direction next. Property appreciation, short-term, long-term. I like using 60 and 10 if I don't have client goals. And in this case, I probably would use that interest in MI or the net worth. We're going to open it up so we can see what this presentation looks like. Let's go ahead and add that date and click on preview. So on here, the output where you're going to be seeing it, of course, is going to reflect your payments may or may not be lower if there's enough of that assistance to cover all the closing costs. In the closing cost details, you will be able to click into that fee detail to be able to see where that gift funds and the down payment assistance is applied. So that's where you're going to see it being applied. When you look at the funds, this will all be pulled over. Part of it is in your prepaid. That is going to be the gift funds. And the other section is going to be pulled into your non-APR cost, because your down payment assistance cannot be applied towards APR cost, or towards your APR cost, not your down, I don't know, towards your, I think it's towards the non-APR. I have so many fees in here that it's actually pulling on the wrong one. So I need a clean one, but it would reflect right in that non-APR cost, in that closing cost. Payments are equal on this one. I am saving more money here, and interest and MI are equal. So yours, because I have that other fees in there that I have created, you will see a savings in probably the monthly payments. You'll probably see a greater savings in that over 60 months, as well as interest in MI would be greater down here in the lower left corner of the one without the down payment assistance. Any other questions on down payment assistance and gift? And the reason why we don't put anything in as a second loan when it's a 0% is because it will affect the blended APR, because you could put it in there as a second with a 0% interest. However, that's going to affect your blended APR, and we don't want to impact that APR, and that's why we put it in the closing cost details. If that down payment assistance was a bulk payment at the end of the loan, or when it's refinanced, or when it's sold, then you would have to make sure that you do touch on that with the client, or if it gets rid of it, a fifth of it for 5 years, so it goes away within 5 years. That is a bigger conversation you'd have to have with your client, and it's not reflected in Mortgage Coach. So all good on that? All right, let me clear out these questions really quick. I have a bunch of questions on templates. So we're going to go in and have a template conversation. I'm going to go back to my Mortgage Coach. Remember, clicking on Mortgage Coach in the upper left-hand corner takes you right back to the beginning. And Eric, I'm actually going to have you email me, tina@mortgagecoach.com, for your question on Total Expert, because I'm going to connect you with my API person and have them look into your account. So there must be something going on in there, and we need to figure out what that trigger is that's not in there in order to be able to know why some of those are not being created automatically from that Total Expert integration. And I am going to go into fees, but I am going down the line. Does Mortgage Coach help with figuring out interest rates and closing costs and have all of those things? So Jasmine, if you have a broker account, that's an individual account, it does not, because none of those integrations we have on that end are available for broker or single accounts. And the reason is just cost effectiveness for not only us, but for the individual to have that setup fee paid is just not reasonable. But if you do have an enterprise account, it all depends on what integrations you have. So for closing costs, if you have Smart Fees or Closing Corp, we do have an integration with Smart Fees and Closing Corp. And that is when I go into here in my closing cost, there's a Closing Corp button, and you would put in information here. And I'm just going to put in some random, I don't even know if it'll pull. Putting in that information, clicking on that next button, and it doesn't like that one. So we got to put in something real. This is actually going to pull over all third-party fees. So this one is great for pulling those third-party fees. When it pulls into Mortgage Coach, You can't change here, but once you click on yes, you do have the ability to change, and you can see between the blue and the white where those fees are. The other one is the optimal blue for pricing. If you, again, have an integration with Optimal Blue, Encompass, Byte, any of those, and it's an enterprise, we do have that Get Pricing button that you can put this information in. And then you would be able to pull over as well, based on this information, pricing information. So I could pull my pricing in. There is some particular information about it. So again, it does base on if you have an enterprise or an individual account. So creating templates. Let's start going into templates. For California, is it possible to get templates from you for different programs? I do not. If you are an individual account, again, you do have to build out all your own templates. If you are an enterprise account, we can build them at the branch level for you for just your closing cost. So your fee templates we can assist with. If you are an enterprise account and you do want a fee worksheet to fill in to have our team build those for you, email me, tina@mortgagecoach.com. But it's not rocket science. It's actually really easy to build these templates out. So I'm going to go in, create new template. I'm going to call it a template. Throw me out a name, Brandon, of one of the templates you want to build. A conventional 30-year. And no, Closing Corp is only available for enterprise accounts. So I'm not going to put that it's a 30-year. I'm just going to put this as a conventional purchase, because I don't have to go down that deep into the explanation. More likely, you're going to need 8 to 10 basic templates. Conventional, FHA, USDA, VA, and jumbo, purchase and refi. Those are the basics that you would need. So the most templates you would need in this closing cost area is 10 templates. If you do produce in multiple states, you can add the state to it, and that way you can have state-specific templates. I'm only licensed in California, so I'm going to do conventional purchase and just not even put a state. Then you're going to go get out your loan estimate, and you're going to go down the line. Processing fee. I type my P, and I could keep typing my P in here and go down to processing fee, or I can scroll. Processing fee, and I'm going to put whatever my processing fee is. It is marked APR. We are all good. Next fee, underwriting. And I'm literally just going through and going back and forth on that loan estimate to my file or my fees in here. Appraisal. Credit report. Now, when you get to fees like lender title insurance, let's find that one. This is where it starts getting sticky. This is where people tend to need more assistance. And on fees like this, there's a few different ways. You could round up here and you can put a higher estimate. Let's say $1,700. Or I could come over here and I can actually do a percentage of the loan, or I can do a combination of the two. So if I know that it is $100 for every 100,000, I could come in here and put my 001 plus, let's say plus, it starts off at $250. I'm going to go in and add it this way, so I can put in how much is it per 100,000 or per 1,000 based on your scenario, and then I can place in that extra beginning fee cost. Owner's title, the same thing. Owner's title, Now remember, when you're doing these, for example, our owner's title insurance is paid by the seller. I want to change it to seller paid here. And I'm going to say this one I can put in just as a dollar amount. Any other fees that you're wondering about, you can even add, if I want to add in my down payment assistant fee automatically. So I have a DAP program, I could put in my down payment assistant fee in here. So when it is already there. So I would keep adding any of the fees on there. So let's say I'm doing an electronic document fee of $12. My I'm looking at the basic ones that you do need, but basically just go down that list on there and just add any of them that you do have. Now another one that has some problems is, raise your hand, anyone in here have the state stamp tax? So do raise your hand if you have state stamp tax, because that is one that is a little bit more difficult for those with state stamp tax, because the calculation on that state stamp tax, in most cases, we cannot put it in here. So my suggestion for that one is to just put the fee, state stamp tax, state tax bond, or you can create a fee on your own, state mortgage tax stamps. There's a few different names in here. But then when you go in there, leave it blank, and then you can just fill it in as you need. So you don't have to worry about adding that fee name, and it reminds you that you have to add that stamp tax in there. But if you do have a state, some states do it on per 100,000 or per 1,000 amount. You can add it as a percentage. You just have to divide that, whatever that percentage is that's per, or that amount per 1,000, and then divide it by the per 1,000 or divide it by the per 100,000 to get what your percentage is. Basic math. Once you're happy with the way this looks, you don't have to start from scratch. And I do see questions in there. I will get to those questions. But you don't have to start from scratch. My next one, let's say that I did this for California, and now I'm producing in Florida. I can click Save As, and now I can put 30-year, or actually I'm not going to do that, conventional purchase. And I like putting the state here if it's multiple states, but I'll also list it under Florida. And that's just in case I forget to hit Florida, I can come in and I can see in there what's going on. Now I can go in here and I can change anything. Maybe my processing fee is different there. Underwriting fee stays the same. Appraisal fee, I'm going to say my appraisal fee is less. Credit report fee might stay the same. My lender's title insurance might change, but I'm not going through and retyping everything out. I'm leaving everything the same. Maybe this is now lender paid, or not lender, borrower paid. So then my next one, I can go in and do the same way. So I'm not recreating it, and you can see that second one was a lot faster than my first one, because I have all those fees in there in order. So my suggestion is start with the loan option. FHA, I know here has a few more fees than my conventional. So I would start with my FHA, because my FHA has pest control. Then when I copy it, I can just delete that pest control and make those changes for the other fees for my conventional loan. Make sense? Okay, I'm going to go back up to these, and we're not done with fees yet, or with templates yet. I just want to make sure. Patricia, yes, DPA is a credit. It is not a fee, but it is placed in there, and we already have logic placed in that down payment assistance fee that says to subtract it from the cash to close. So whatever they're required to bring in for cash to close, it's subtracted. It's actually set up properly, so it subtracts it from the non-APR cost, then it goes towards the actual loan amount. I built in a bunch of fees in this account before we had that DPA fee in the system, so I chose the wrong one. That's the only thing. So it is set up properly in your account. If you haven't billed any of your own fees, then your fee will be set up properly to go as a credit. Brenda, if you can email me, and then I will forward that email over for you so they can contact you on that information. And for California, do you have a generic chart for title and escrow fee percentages for loan amounts and sales price? No, I do not. My suggestion, Gerardo, is to go to one of two places. If you are using the same title and escrow company, or if your clients always pick the same title and escrow company, I would go to them and ask them for a fee sheet. They will give it to you because they want your business. Or I would go and ask 3 companies, because by law we're supposed to give 3 choices, compliance wise, and then I would just average out the 3 of them or take the highest of the 3. So then when I'm educating my borrowers, I would tell them based on this scenario. And the reason why is because every single area of California, title and escrow fees are a little different. So if you're in Northern California, it's going to be different than Sacramento. That's going to be different from LA. That's going to be different from San Diego. So those fees are not standard across all of California. So you want to make sure that you're using your area. Okay, all caught up with questions. Any other questions on the fee template? Because we're going to move to the product template. You're welcome. Product templates, very important for building out that 5-minute TCA. Again, product templates, super simple to build. You're going to start with new product template. And on product templates, what products do you want to build? The products that you produce. If you never do, or if you rarely do a USDA, then don't add a USDA product template unless you want it in there for that one-off. If you never ever do a VA loan, if you don't do government loans at your location, don't add government loans in here. Only add the loans that you do. So I would start off, and I would probably start by building my conventional 30-year, 20% down. The more specific you are here, the more specific you can be down in your template. So conventional 30-year, 20% down. I would not have upfront premium. My down payment percentage, 20%. I'm only adding the things that stay stagnant. I would not add an interest rate. That changes every time. I'm going to add in my months for my term. It is a fixed loan. Interest only and balloon does not pertain. First one I'm going to go into is my closing cost. This is where those closing cost templates come into play. Now I'm going to come in here and I'm going to drop in my closing cost, whichever one I feel is going to be the best fit for this loan option. If I make changes here, it's going to stick. So let's say that you are someone who has branch templates, but you're always changing a certain fee on a branch template. I can go in, change the fee in here, and it's now stuck. So it's not changing that original template. It's only placing it in my personal templates. Once I'm happy with it, I'm going to apply that to the loan. If I'm always charging points, or if I wanted one that always charged points, I could add that in there. Clicking that X, it is saved automatically. Then I'm going into the monthly cost. So HOA dues, if you're doing construction and you're doing a unit of 48 houses, build out a template built just for that construction area that you're selling the homes for. Then you could put that HOA dues in there and you can name it that whatever that build is. And that way you can just click on that when you're building out your presentations versus going in and remembering to add those HOA dues in. Otherwise, I'd leave that empty because it does change based on the property. Hazard insurance and property tax. You can add this as a dollar amount, or you can add these as a percentage. Based on your location, you would want to add them in whatever's easier for you. The most important part is with your templates, stay consistent. Whatever you use here in one template, you want to make sure you're using it in all the other templates. Same thing with your reserves. Whatever you're using here, I'm going to collect 14 months here, the 1-year premium plus the 2 months, and I'm going to say 3 years on my tax reserves. Stay consistent. So when you do build out your presentation, you know mentally, oh, I have 2 and 3 months. I need to actually change this because we're closing it in a month that I have to collect a few more months. And I can go in when I'm building it and I can change it out. But to start with, I want it consistent with whatever your average is. Once I'm happy with that, I can click off. If I was making this a construction loan, I could put in the build period and the period of time. Again, more likely you're not going to have a construction template unless you have a builder contract with the builder and you're constantly doing those with the builder. Then build it in so you're not going in and recreating one every single time. Once I have my first one built, there is that save as. I'm going to click save as, and I'm going to make my next one 30-year with 10% down. I'm going to change this to 10%. I'm just going to go into my monthly cost, and I'm going to add in my mortgage insurance. I can either leave this blank or I can put a high average. My MI cutoff, I'm going to put it 78 months. And make sure you know what your company is. Most companies are 24 or 120 months. So whichever one yours is, make sure you're asking. If you don't know, don't just do that assumption. But you can go in and add the minimum months in there. Now, if you leave this information in all of your presentations, it's not going to impact it unless you have something in these. So it's not going to hurt it when I go down the line having this information in there unless there is a mortgage insurance on there. So that one's complete. Then I can go in and build out my next one. Let's say now I want to change it to an FHA. FHA 3.5%. I'm going to change my percentage. I'm going to add my upfront FHA. I'm going to add it as a percentage, 1.75. 9 times out of 10, I add it to the loan amount, so I'm going to click that add to loan amount. My fees, my closing cost, I know here in California, the main difference is the pest control. I can either drop in a template or I can even just add that pest control here to be able to have that already in there. Applying that to the template, that's been changed and fixed for me. Now I'm going to go in my monthly cost and I'm going to add my mortgage insurance. Simply removing the minimum months and the MI cutoff. I'm going to make it 360 for that minimum months. Now my FHA is done. So you can see in just a matter of a few minutes, I've gone in and built out 3 product templates. So it is very fast once you do it. Refi. So on a refi, Brandon, I would not take time to build out a template for a refi. And I'm going to explain to you why. When you do a refinance scenario, the very first thing you do is you copy it from the current loan scenario. So copying it from the current loan scenario, if I was to do that and then lay my refi template over it, I could be overlaying information that I copied from that original loan, and I don't want to do that. So when I do refis, I actually go in there and add in each fee into there, and I can show you really quick how to do a quick refi scenario after this if you want to see that refi scenario. any questions on the product template or any product that you wanted me to build a product template for. And I can even build it from scratch if you want, because these are really fast. VA. Okay, we're going to start from scratch on that VA. And this is going to be a VA. Now with VA, you want two of them. You want a first time use. Upfront premium, you're going to have that guaranteed fee for your VA. There is no down payment amount. That is left as 0. Guaranteed fee is, it was just changed is what I was told to 2.3 on that first time use. I'm going to add that fee to the loan because most of the time that is what I do. Adding in my prepaid days of interest. Adding in, most of the time, VAs are almost always a 30-year loan product. Once in a while, you do get a 15, but on those 15s, your funding fee. So if you are doing 15, you would do a 30-year VA, a 15-year VA. Going into that closing cost, I'm going to drop in my VA closing cost template. I'm sure I have one in here somewhere. Doesn't have much in there, but whatever. I would apply it to the loan. And then I would simply add my closing cost. So I'm going to do my standardized fees that I normally have in here, and everything else is pretty standardized for it. But then when I need to build out that second VA loan, I can go in there and I'm going to click Save As, VA Subuse. What's the difference in the VA subuse? And I don't know if this one changed or not. It's that funding fee. So make sure, because Robert, those were just changed at the beginning of this year. Make sure you do verify funding fees on there, because I don't know if the 2.3 and the 3.3 is correct. That is what someone else told me. That's the only thing I need to change on that second one. Cool? Yep. Okay. Let's Janet, I don't remember if I recorded last week. Send me an email to remind me. If I did record it, I'll send it to you. But I'm going to give everyone, actually, let's go in and give everyone this playlist. This is my favorite playlist of all time. And I'll tell you why. Because everything in here is such short videos. Anyone who knows me knows the less I have to do, the more happy I am, because I like to live my life by experiences and having fun. And so the things that aren't fun, I don't want to have to go in and do. So I'm going to drop this in the chat box for everyone. And I'm going to open it up. So this playlist is a list of different options, and it goes in short. This is straight to the point. So if you just need to know how to build out the product, this is the great thing to do. Now, what this doesn't teach is any of the sales aspect or any of the advice on how to talk to it or anything. It is basically building it. But how to build that cost of weight presentation is in there. But if you do want last week's training, I can, Janet, go in and check. Actually, I'm going to pull up my other window and see if I did do it, or if I did record it, because it would be in my list. Is that 220? And I do think I have it here for you. So there's that playlist as well. Again, I dropped it down in the panelist link for you. I'll drop it in the Q&A to you as well. So it's right in your Q&A box. Okay, are we ready to move on to to the last template. The last template is called a strategy template. This is the most amazing template because basically it is scenarios that I show every time. Anyone who has an account that was billed after November 2018 has a strategy template tab and might have some strategy templates already located in there for them. But if you don't fret because you can build them yourself. So let's say I am now doing a lot of 20 versus 10% down. I'm going to click on new client and I'm going to switch over. Yes, it's a strategy template. And I'm going to put 20% versus 10% conventional. This name does not show up for your client because you're going to be copying this. So you can use whatever name you need in order for you to be able to identify what this is going to be. That's the only thing I'm going to put in this first page. I'm going to then go into my goals. And I am only adding the things that are stagnant. Purchase a new home. I'm going to go into my product. Actually, in here, I do like adding in my contacts, your new home. Just so it's already there. If you only produce in one state, add that state in there. Then I'm going to go into my product. What do I need to do? I need to give it a name. So this is a 30-year with 10%. I'm going to add the product from a template. If I have a 10% template, I can just drop that in there. All of my closing costs, everything should be in that template. So I don't have to add anything else into that template. It should all be good and ready for me to use. And I don't know what's up with that mortgage insurance. Anything that is missing, I can go in there and adjust it. And then I can add my second product. Second product is going to be the 30-year with 20% down. Again, adding product from template. Or if you want, you can also copy it from that first product template that you did and click on OK and just make changes. So this is now 20%. And the only other change I need to make is in my monthly. If I did put a mortgage insurance amount, I would just simply remove it. Everything else should be good to go. Last thing is I'm going to set up my analysis back here for my average client. So now when I open up my strategy template, I'm going to see that strategy template in there for me. Now, if I need to make changes to the strategy template, maybe I see an error or I'm always going in and changing something, I can edit this template anytime I need. I can go in there and I can make changes to that template. But what I'm going to do is once I have a new client, I'm going to click on copy to new client. And I would go in, I'm going to use Avery as my client. I would add in Avery's information, add in the home phone number, add in presentation name. I'm then going to skip to my assumptions. Everything else is in there that I need. I'm going to add in how much they qualify for. I'm going to, again, skip right over to my first product. First product, what do I need in here? I need an interest rate. If there is monthly MI at your company on here, you would just then go to that monthly page, add in that monthly MI. I'm going to go to my next loan option, my 20% down, add in my interest rate. I'm going to say interest rates are the same, and I have a complete presentation. So this makes it so much faster when you're always building out the same type of scenarios. As you can see, it took me 2 minutes to build out this presentation. The only other things I have left to do on here is if I do want to change that analysis window for my client based on their hopes and dreams, I could change that. And then I would go down and I would add a video on it. Otherwise, it is a complete total cost analysis. And I did remember to record this for anyone who wants it later send me an email, tina@mortgagecoach.com, and you'll be able to get this recording. So everything's in here, all is good. It's ready for my client. Let's talk a bit, because I do want to get that refinance in there. Let's talk a bit about refinances. You can have a strategy template for a refinance. So if you have a newer account, you will see in there, there is a 30, 15, let's see, mine's not a newer account, so I built most of these in here. 30, 15 cash out, I believe, is what it's called. I'm going to start with new client. And Brandon's going to be my client. I'm going to go in and add in the phone number. That's good that you're still here. I'm going to add in that it's a refi. And I like putting the date in here on the refi, or the year, so I know when I touched it last. Contact information. I would put the actual address in here. And you only wish that you could live out here by me. Actually, no, Brandon, so. On the goals, I personally like using other, because I like to manipulate my own numbers. If you are someone who wants it just to add for you, if you click pay off debt and you put in, let's say 40,000, what it's going to do is it's going to add that amount here to your payoff amount that you place when you're doing your assumptions. So it's automatically going to add it for you. I'm just going to click others so I can add my numbers or do my numbers myself. Assumption, what does my home qualify for appraisal today? I'm going to say 475. Only field I'm going to fill in here. I'm not going to fill in any of the others. I'm going to leave them all blank, because they're going to be automatically filled in through this page. When was the first date that I purchased? So, and you can see, I'm going to do that again just so you can see how I did it. I can either type in the numbers over here, or I can go here to the calendar, click that down arrow, and it opens up so I can go to the years. So I can go in and quickly just choose that amount. The original loan amount, I'm going to say, was $299. Originally 5% interest, $360. And what you're going to see is it automatically gives me a remaining balance. This is based on normal amortization. So I don't have to go in there and do the math. Now, what if Brandon made some extra payments and his actual payoff amount is $220? I would just highlight this and type it in. Or I know the actual payoff amount with that added interest in. I can go in and increase it to what that actual payoff amount is, but it's not going to impact my P&I payment when I make that adjustment at this point. If it's a fixed loan, leave it at fixed, or you can switch it to ARM if you are taking them out of an ARM loan. Now here, put the actual hazard insurance and the actual property tax, not the percentages, because what's going to happen if you do percentages is it's going to pull percentages off of the new product you build. So you don't want to change these amounts. So putting those actual numbers in. Here's a great field that we don't talk about a whole lot, other. What if there is, let's say that you are refinancing a satellite dish that they're currently paying on, and that is a $600 monthly payment. I could type in satellite 600. Why would I do this? So I can see in that DTI how it comes into play. Let's go ahead and play with this. I'm going to just put sat, and let's say it's 450, just so we can see where it comes into play. If you place in MI, that would also be taken into consideration. Again, I'm going to skip the affordability. There's nothing I have to place in there, so I'm going to go right to my product. Let's say we're doing a 30-year fixed. Here is the process of procedure. You have to do it this way or your numbers don't work out. Copy from the current loan scenario and click on OK. switch it to a refinance scenario. Now when I come down here, it is switched to a basic 30-year every time. I can come in and make adjustments to the interest rate. Then I'm going to come add my closing cost, making any adjustments in here I need to adjust, applying it to the loan. If I had points, I could add the points. I'm going to only do 5 days prepaid interest. I almost always try to close my refis at the end of the month. Hazard insurance, property taxes in there. You only need to add the months required for you to do them. The second product, let's say the second product, I'm going to roll that extra field in, that other field. I'm going to put 30-year with cash out, actually with SAT pay. So we're paying off that satellite. I am going to copy the loan that I put all the fees in. So I'm not re-adding those fees and adjusting it. Let's say that satellite was $20,000. I'm going to go in and simply increase this $20,000 to include that satellite payoff. And I'm going to go in and I'm going to remove that satellite here. Now here in this side is where I'm going to see, I got to add in how much they make. So in the affordability, current gross income. Now you'll see the top end and the bottom end of their DTI based on paying that satellite off. Now, the other thing you can see is down here, the amount. If I want to roll this cash to close into the loan, I'm going to go back to that product. What I'm going to do is on the second page, closing cost details, we have a button, add all fees to loan. Click that button. Apply it to the loan. Don't forget to apply it, because if you do and you just X off, it won't be applied. You see, I still have a small amount. That is my prepaid days of interest. I'm going to check that little box and click the next. And now what you see is a 0 amount. I'm going to do that to the next loan as well. Now, if I did that first, then I wouldn't have to do it to the second loan. When I copy the loan, it'll automatically be there for me. And then when I next, you'll see I have my full $20,000. Anything you guys want to do with the refinance scenario that you would like to see me do? We have like 6 minutes. And again, you can raise your hand if you do have a mic, and I can unmute you as well. That is a great question. What if they have rental income? So one of them that I've been asked frequently is they're trying to decide, do they keep their house and rent it out, or do they sell their house and use the equity in order to pay it back or pay their down payment? If you are showing that scenario, and I'm going to go back to the first page, and we're going to walk through it as if it was that scenario. So I would, on this scenario, still click it as other, because I want to show that current loan scenario. I would place in the current loan scenario on here. I'm going to remove my satellite payment at this point. Then my first product is going to be purchase / rent. This is going to be purchase a new home, but rent out the next home. It is not going to be a refinance. It's going to be a straight purchase. I'm going to say they're looking at purchasing $550. Their down payment amount is going to be 20% down. Interest rate 4%. I would add in my closing cost, or I could simply drop in a template at this point. Because it's a basic purchase, I could just drop in my 30-year template. But what I'm going to add is, because they're going to have rent here, I'm going to, in this other spot, add in rent. I'm going to say they're going to get $19.75. I added it as a negative amount. The reason I did this is because I want to reflect that income coming into them every single month. So that is why I'm adding that rental income there. Everything else would basically stay the same for me. And then I would go to my next one. This is where I would then do my refi into a 30-year. Again, copying it from that current, adding it as, yes, it's a refi, changing my amount here. Actually, wait, it wouldn't be a refi. This would be sell and purchase. So this one's going to be sell and purchase. I'm going to copy it from that purchase and rent. So so I back up because I messed that up. The first product is going to be purchase and rent. The second product is going to be sell and rent. I'm going to simply copy their purchase. What I'm going to reflect on this one is actually the equity that they have coming back to them, so they don't have to show this money. Now, how do I figure out the equity? How much money do they have coming back from them? Less, I like to use 7%. 6% to pay off the realtor on both ends, and then 1% extra for any other fees. That's what I use. If you know that your realtors are not collecting, maybe it's a 5% in your market, use 6% then, because that tends to be a pretty close number. So then when I move here, closing cost detail, I'm actually going to add that fee as a contribution. I would add in whatever, and I'm not going to do math. I'm just going to say it's $120,000. I'm going to place it as broker, because that's going to be from a third party somewhere else. It's based on that equity, and apply it to the loan. What you're going to see happen is it's going to show them how much money they'll have left, or the difference between that equity and what they need to come in with. So any questions on that information? Now, when you do show it to the client, you do have to go in a little deeper into explanation, because, and I'm just gonna, let's cheat and just go to preview. So if I'm showing it to the client, what I'm going to explain to them is their first product is actually both their current and their purchase. This is their first product. So their payment is going to be both of these payments. Oops, I forgot to remove the rent. Let's go remove that rent. And next, to make it change, okay, now it should look right. So their home, if they keep their current and they buy, they're going to be paying the $2,152 plus $700. Because of that offset of that amount that they're renting it for, they're going to only have to be really applying $700 towards the purchase. So in that case, it's both of these. Where here it is about $150 less if they were to keep that home, continue building that equity. The other factor is, when you're down here, show your total net worth. And we're gonna, whoops, analysis, total net worth. And the reason why I'm showing that total net worth there is because when you show total net worth, they're going to have the total net worth of both of these homes by keeping it in that 15 years. Where if they sell and they repurchase, they only have the total net worth of this one home. So you are actually showing them how to build wealth versus how to do the so-called American dream of purchase a new home, which isn't valid in today. The American dream is to build wealth. So let's show our clients how to be able to build wealth by using and leveraging what they already have and then building on it. That's the same thought as purchasing with 20% down versus 10% down and then investing that other 10%. I'm teaching my client to build wealth versus how to purchase a house, because purchasing a house is really, let's get real, it's a transaction. Building wealth is a way to set them up for the future. And that's what we want to be doing with our clients. And that's how we're going to set ourselves apart, is by teaching our clients how to set themselves up for the future versus being able to have just the one house, diversifying their money. And that way, if something was to happen, they have two homes or they have a home and an investment account. So they're diversified versus they just having that single home. Any questions? And I am 3 minutes over, so feel free to jump off. I don't feel bad when anyone jumps off the call, to be honest with you, because I know that you guys are busy out there in the field. But I do want to make sure that if there are questions, we do get them answered, because that was a deep dive into refinancing and kind of a deeper scenario that a lot of people don't think about showing. Okay, looks like there's no questions. Again, if you do want a copy of this presentation, please email me, tina@mortgagecoach.com. I will send it over to you when I do upload it into YouTube. And actually, I'll just send you the whole playlist, because all of the old ones are in there as well. And that way you can have the old ones and this one as well. So thank you guys for joining me. I hope that you have an absolutely fabulous weekend and you're able to get out there and enjoy your family and friends and produce some great loans this week. Have a great day. Bye-bye.